In many businesses, expenses are paid before the benefit is received. When this happens, accounting rules require a specific accounting treatment known as a prepayment. A prepayment is an expense paid in advance. This means cash is paid first, but the benefit is received later. In accounting, we do not always recognize expenses immediately when cash is paid. Expenses are recognized when they are used or incurred, meaning when the benefit is received, not when the cash is paid. This is because of the accruals concept. The accruals concept tells us to match expenses to the period they relate to, not the period when cash is paid. Examples include rent paid before using a building, insurance paid before cover starts, and software subscriptions paid in advance. Let's look at where a prepayment appears in the accounts. A single prepayment affects 3 different areas, but not all at the same time. First, let's look at cash flow. Cash is recorded if and when cash is paid. Sometimes a business pays up front. Sometimes it receives an invoice and pays later. Either way, cash flow only cares about the actual movement of cash. If no cash has been paid yet, nothing appears in cash flow. Now let's look at the profit and loss account. The profit and loss does not show when cash is paid. It shows only the portion of the expense that is used or incurred during the period. For prepayments, that means we spread the cost over the months that receive the benefit. Each accounting period shows its own expense only. Finally, we look at the balance sheet. Any part of the expense that has been paid for but not yet used is shown here. This is called a prepayment, and it is a current asset. It represents a future economic benefit. The balance sheet shows what is left unused at the reporting date. Let's look at an example to see how this works in practice. The business pays rent on the 1st of December 2024. The amount paid is £12,000. This payment covers the period from the 1st of January 2025 to the 31st of December 2025, which is a total of 12 months. If we divide £12,000 by 12 months, the cost is £1,000 per month. Now, let's think carefully about 2024. In December 2024, the cash is paid, but no rent is actually used in that year. The building is only used from January 2025 onwards. So, in the 2024 accounts, the profit and loss account shows no rent expense because no benefit has been received. The balance sheet shows a prepayment of £12,000. This £12,000 is treated as an asset because it represents a future economic benefit that the business will use in 2025. Now we move into January 2025. In January, the business uses 1 month of rent. That 1 month costs £1,000. From an accounting point of view, this means 2 things happen. First, in the profit and loss account, we recognise a rent expense of £1,000 because that is the amount of benefit used during January. Second, in the balance sheet, the prepayment is reduced. It started at £12,000 and after using 1 month, it reduces to £11,000. A simple way to think about this is that we are moving £1,000 from the balance sheet into the profit and loss account. In February 2025, exactly the same process happens again. The business uses another month of rent, which again costs £1,000. So in February, the profit and loss account shows a rent expense of £1,000. The prepayment in the balance sheet reduces from £11,000 to £10,000. It is very important to remember that February's profit and loss shows £1,000 only. It does not show January plus February. Each month stands on its own. In March 2025, once again, 1 month of rent is used, so the profit and loss account shows another £1,000 rent expense. The prepayment reduces further to £9,000. Each month follows the same logic. The profit and loss account shows the expense for that month only. The balance sheet shows what is still unused. This same pattern continues every month until December 2025. Each month, £1,000 is charged to the profit and loss account. The prepayment reduces by £1,000. By the end of December 2025, the total rent expense recognised in the profit and loss account is £12,000. The prepayment balance in the balance sheet is £0 because the full benefit has now been used. Let's recap the key points about prepayments. Prepayments are expenses paid in advance. They are shown as current assets in the balance sheet. Cash is recorded when it is paid. If an invoice is received for a future period but has not yet been paid, there is no cash movement yet. Expenses are recorded when they are used or incurred. The profit and loss account shows the expense for the period. The balance sheet shows what remains unused.